Exercise 12.7 asks us to look at some more risk ratios. And I know I'm sounding like a broken record, but take a minute to jot down what you know you're going to need. Your receivables turnover ratio is sales divided by average accounts receivable. And remember, the average accounts receivable is the beginning and the end added together divided by 2. And I don't know what the finger was supposed to do, but I did. Okay, the inventory turnover ratio is cost of goods sold divided by average inventory. Beginning inventory plus ending inventory added together divided by 2. Current ratio is the current assets divided by current liabilities. You pick those up right off the balance sheet. The acid test is a more stringent version of the current ratio. It doesn't look at all current assets, just the quick assets. So we'll call those the quick assets. Have to be careful how I abbreviate that. Divided by the current liabilities. And the debt to equity ratio we've done before, and that's the total debt, including the long term, divided by the equity, which in this case is just common stock and retained earnings. Okay, so let's take a look at the receivables ratio. The sales, they give us the sales in the additional information on page 595. The sales are $1,890,000. And the accounts receivable, the beginning accounts receivable is 98. The ending accounts receivable is 102. So we add those together, we come up with 2 million. Divide by 2, that's 1 million. So our average receivables are 102,000 plus 98,000. Add those together and divide by 2, and we come up with 100,000. Divide that into 1,890,000, and we come out with a accounts receivable turnover ratio of 18.9 times. So 18.9 times a year they collect all of their bills. That's less than a month. That's pretty fast. That's good. Now, their inventory turnover ratio is their cost of goods sold, and again, that number is given to us. It's $1,394,250 divided by the average inventory. So the beginning inventory was 90, the ending inventory is 105. So we add those together, that gives us 195, and divide that by 2. So that's 90 plus 105, and we divide that by 2. And when we do that, we divide that into the 1,394,250. We come up with 14.3. So again, that says that this company turns over their inventory 14.3 times a year. So that's less than a month. So that's really good. Okay. Now their current ratio is their current assets. And in this case, the current assets are cash, accounts receivable. See, so let me write this down. So we have cash, 242,000, plus accounts receivable, 98,000, plus inventory, that's 105,000. And I'm just taking these numbers right off the balance sheet. I'm just going right down the balance sheet. And investments of 5,000. Altogether, that comes to 450,000. and I'm going to divide that by my current liabilities. And my current liabilities in this case are my accounts payable of 109 plus my interest payable of 7 plus my income tax payable of 9, and altogether that equals 125,000. So when I divide that, my current ratio is 450 divided by 125. That comes out to 3.6 to 1. So for every dollar of current liabilities, I have $3.6 of current assets. Okay, the asset test includes the same sorts of things except it leaves out the inventory. So we're still going to have our cash. So we're still going to have 242. That's our cash. We're still going to have our accounts receivable of 98. We are not going to have our inventory of 105 because that's not really a quick asset. It takes some time to sell that, but we will have our short-term investment or our investment of 5. So there's our quick assets. Just our cash, our accounts receivable, and our investments, and we're going to divide that by the current liabilities that we determined earlier to be 125,000, and we do that, we come up with 2.8 to 1. So for every dollar of current liabilities, we have 2.8 of very liquid assets that we can use to honor those liabilities. And our last ratio is our debt to equity ratio. And our debt to equity ratio is our current liabilities, the 125, plus we have a note payable. So that gets included because that's our total debt. And in this case, we only have common stock and retained earnings. So when we put those together, our debt to equity ratio is our total debt, 125, plus the note, and I think the note is 110, right? Okay, so that gives us 235, 110 plus 125. 235 is our debt, and our common stock and our retained earnings is a combination of 800,000 in common stock and 357,000 in retained earnings. That's 1,157,000. So our debt to equity ratio is 20.3%. Again, the key with the ratios is to make sure you know what you're talking about. Take a second, jot down what numbers you need for each category, and then go fill them in. It takes a lot less time to write in the numbers and then go look for them than to write in the wrong numbers, come up with the wrong answer, then go back and look for the right numbers.